Here we go. This is chapter cost of production. Uh, um, Industrial organizations study how firms make a decision about pricing their output or how many quantities they should bring to the market. Uh, and that one depends on the market condition they face. Okay, we're going to talk about this later. Perfectly competitive market, or is it monopoly or monopolistic competition, and so on. You just get the hang of this basic here. We're talking about production function and cost function, which is pretty common in all of them. Okay. We do make an assumption that the goal of the firm is to maximize its profit. Okay. Of course, everybody want to do business in the market. They want to get as much as they can. They spend as least as they can. Cost minimization and profit maximization. Okay. And we know profit is total revenue minus uh, total cost. Okay. We can demo it like this. Total revenue, TR, is P multiplied by Q. Okay. Uh, P multiplied by Q. Uh, Q is the amount of quantity that firm produce and what prices they selling it. Let's say Brahms make 1,000 ice cream in one day and sell it for $2 each. Okay, 2 scoop, $2 each. Then how much is total revenue make? 1,000 multiplied by 2, $2,000. Okay, then total revenue amount the firm receives for the sales of its output. Quantity output the firm produces times the price at which it sells its output. How about total cost? Okay, is the market value of the inputs a firm uses to producing those goods. Okay, that's just simple definition here. If Brown wanted to make ice cream and sell it, he needs what? He needs ingredients, milk. Well, he needs a building, fixed cost. You know, he needs freezers. He needs hiring people to do it, labor. Then ingredients. You know, be sugar, milk, and candy, and so on. Okay, those are the inputs that goes into the production for the firms. All right, just very simple definition so far. Okay, let's see here. Let me situate. Okay. We also include the opportunity cost in the cost. We already know about the opportunity cost, right? The cost of something is what you give up to get it. Okay. Then the firm's cost of production include all the opportunity cost of making its output of goods and services. Okay, then we come with these two definitions, implicit cost and explicit cost. Okay, well, let's say you open up your own ice cream shop. Okay, besides you got to pay money to rent, buy your equipment, pay for your labor, and so on. You can add all that up. That's accounting cost. You also add up your opportunity cost of time that you could work somewhere else, make $30,000, $20,000. You gave that one up to come to do your own business. You add that one in there, that makes the firm cost of production. Okay, then let's just show it here. The implicit cost, okay, is input cost that requires an outlay of money by the firm. Okay, again, you pay money to your labor you hire for your ice cream shop. You pay money to buy your equipment, you pay rent, and so on. Those are explicit costs. Implicit costs, input costs that do not require an outlay of money by the firm. Again, it's kind of time. Well, you didn't, spend any time to work, and let's say you could work some ice cream shop and making $50,000 a year managing another shop, right? You gave that one up, but actually you didn't pay for it. But that's the opportunity cost that you add on to this. That's implicit cost. Okay, then your total cost going to be implicit plus explicit cost. Okay, you say, okay, 1 year my shop of ice cream shop that I have, I'm running, it's cost me about $100,000. Okay, you gave up $50,000 not to work in another place, plus you pay money. You pay $50,000 for your other costs, other expenses. Let's say here. Another example of, let me just put this, okay, red color. Okay, another example of the explicit cost, that opportunity cost, is cost of your financial capital. Okay, what does that mean? Let's say, well, you open up your ice cream shop, you had $10,000 on your own, and you invested in there. Okay, that's your money out there, right? But again, you could have that money in the bank or CD or what other places, let's say, make about 10% of it. You gave that one up. Okay, that's the cost of financial capital as the opportunity cost that you invested on your business. Implicit cost, the interest income not earned on financial capital. You gave it up. Okay, owned as a saving. It could be invested in the other places you make money, but you invested in your businesses, but you got to add that cost to it too. Okay, it's not shown in the cost by accountant. Remember, accounting cost is different than economic cost. Accounting cost is what money outlay for running your business. Okay, how much you spend on your labor, on material, and so on. Economic cost is a little bit more than that. What you gave up, you add on to it too. Okay, let's just see it here. Then economic profit is different than accounting profit. Economic profit means, well, remember, your cost is higher. Your profit is going to be lower because economists counted the opportunity cost. Total revenue minus total cost. Total cost includes both explicit and implicit cost. Accountant, they said, okay, total revenue is minus your total explicit cost, what you spent. Okay, they don't consider the implicit cost, usually larger than economic profit. Okay, like this table here shows, pretty simple demonstration of it, right? On the first one in here, let me just see if I can draw this here. Okay, here you go. Okay, it's just this one here is your economic profit. Okay, remember, whatever you went, revenue, which was what? Price multiply by how many units you sold, like ice cream, 1,000 a day, $2 each, $2,000. Your explicit cost, okay, whatever you pay for your labor and other stuff, plus your implicit cost, whatever you gave up, okay, that makes your profit lower than accounting cost. Accounting cost is, they just consider the implicit cost. Okay, just the question comes like true, false, multiple choice, and so on, is based on these definitions here. All right, let's go on to here. Now we're going to talk about production function. What is production function? It's the relationship between quantity of input used to making that good and the quantity that output that good. Okay, we're just going to use a graph here. Okay, just going to use a graph, pretty simple. We put input here, okay, and we put output here. We show it with Q, okay. How these two relationship exist? If you don't make anything, you don't hire nobody, make no ice cream, is zero, okay. Maybe you hire people, let's say your fixed cost is already there, your building and so on. We're going to talk about it later. Then you hire one person, maybe bring 1 unit of ice cream. You bring 2, then they bring, let's say 3. Okay. Then as you bring more input into these production facilities, you're going to have more output. You get to the point that it max out. You can't even bring any more. You put more input, it doesn't increase the output. We're going to talk about that. Diminishing marginal product, we call it. Okay, we're going to talk about that. I just, initially give you a head start on that. That's one of the main important concepts in production function. Okay, then production function is a relationship between input and output. Okay, it gets flatter as production arises. Okay, which calls marginal product. What do we mean by that? Increase in output that arises from an additional input in a decreasing rate. Okay, those of you might know, derivative, algebra, calculus, and all that. Some of you good on that, some not, but everybody's different. Then we're talking about the slope of this curve. Okay, it decreases. In reality, let's say more ice cream place, I hire 4 people to run it. Okay, they do produce, let's say here, I say 4 people together, that's my variable cost. They bring maybe 50 ice cream. Okay, they teamwork, they all do together, right? One may grab the coin, the other one, make it, the other guys do the cash register, and you're familiar with that, right? Let's say you hire another guy here. Okay, well, they do the same teamwork and all that. They maybe bring 60 ice cream. Okay, what do we mean by marginal product? We increase one input. Together they brought 10 margin. This is marginal. They brought 10 more ice cream to the production. Let's say we hired another guy. Okay, 6 of them. Okay, they bring 65. Okay, that's the definition of decreasing marginal product. Together, these guys brought 5 more. You see, it decreases. Okay, if you get about 7 people, maybe they can't bring any more, maybe 1 more. It keeps decreases. Okay, why is that so? Okay, why is that so? The marginal product is diminishing, we call it. Well, it's the economy of a scale. You get to the point that you hire more labor, they just go in each other way, and they cannot do as much as, the max probably would be 5 people to work together. Okay, more than that is going to just run problem with it. Okay, let me get this. That's what we're going to do in the next chapter here. Okay. All right. This table is pretty good. Just study it, and you get hang of production function and cost function pretty good. Let's say number of workers, 0. Well, nothing produced, right? Let's say you hire 1 person. Your factory is already established. It's a Braum ice cream. You already got your machine, your building, everything's out there, right? Then they can bring 50. unit. Okay, 50 unit. Okay, one person can do it. Now we're going to calculate those marginal product. Okay, just what we did before. Cost of factory, let's say is 30. Okay, $1,000, whatever unit it is. You establish your factory, it costs you 30, unit, $30 for simplicity. Here we use just a dollar amount. And let's say your only variable here is labor. Okay, then you hire one labor. Cost of factory, which is fixed cost, is stay the same. It doesn't change, right? It stays the same all the way through. Okay. Now, number of workers you hire, you got to pay them, right? Let's say you pay them $10 each. Your variable cost is going to be 10. Okay. The total cost of input that factory uses is at the last column. Okay. Let's say you got $30, your fixed cost. You pay one labor $10, you already had just one labor, right? You add them up, your total cost, let's assume, would be 40. Okay, all this together brought 50 unit of product. Okay, from 0 we jump to 50. That's the marginal. We talked about it before, remember? Let's say you had another workers here, 2 of them. Okay, together they bring 90. It jumped 40. Okay, that's your marginal. Okay, from 50 to 90, it jumped 40. Okay, your fixed cost is the same. Your labor cost double now because you got 2 people here, and your total cost is going to be 50 column. Cost of workers and cost of factories. Okay, 20 plus 30, it becomes 50. You just go on like this. As you noticed, marginal product of the labor keep diminishing. Just the example I used in the previous slide. Okay, you got 6 people, they cannot bring as many as, they bring 150 all together. Maybe you get 7 people, they cannot bring anymore, maybe 155. That's where you stop. That's to minimize its cost here. Okay. All right, just glance through a slide with all this here, and let's go to the next one. Again, what is that marginal diminishing marginal product? Is the marginal product of an input declines as the quantity of input increases. Okay, our example was just one labor. As we increases, the total production is going decreases. Okay, production function gets flatter and flatter, right? And you can draw it actually. Okay, let's just draw a production function, which I put labor here. We assume everything else is constant, your equipment and so on. And we put the quantity here. Okay, it says the curve is going to be like this. You get flatter and flatter and flatter and flatter. Okay. Then actually it's going, decrease. You might just stay there like that, because those people stay there idle. Okay, they cannot bring anything more. Okay, that's what diminishing marginal product means. How about cost function? What is definition of cost function? Is a relationship between quantity produced and total cost. Remember, we already talked about total cost. Economists look at the total cost as implicit plus explicit cost, whatever it takes to make that product. Okay, whatever you pay money-wise plus whatever you gave up, could work somewhere else. You add that one too. Whatever you could make out of the capital, your money that you invest in that, That's included in there too, the total cost. And this one is going to be different. It gets steeper and steeper as the amount of produce rises. Okay. Then here we have diminishing because of diminishing marginal product. Okay. Because of that, it gets steeper and steeper. Okay. Which means producing extra or additional unit of output requires a lot of additional unit of inputs, which is very costly. Okay, let's look at the chart, the graph here. That was production function here. Now, total cost curve, okay, that was production function. Total cost curve, you put the quantity on horizontal, and you're going to see how much it costs you to do it. You put it on vertical, okay? $30 in our example was a fixed cost. No matter, you didn't produce anything, but you spent $30,000 to build it up. Can't change that. It's already gone. It's fixed cost. Okay. Now here you make 2 units. Okay. You pay one labor $30, then it's going to be 30. Okay. 50 unit is going to cost you 40. As more unit you produce, your cost is going to be higher. Okay, but in a diminishing return. Okay, in a diminishing return. Okay, why is that so? Because this curve, as you put more labor here, okay, they produce more because of marginal diminishing product, but they cannot produce as much. Okay, that way, all these people together, they can probably max it out this many. That's it. Okay, you pay more money, hire more people. They cannot produce anymore because of this here. It's a good, put this together, okay? Let me erase it, and then again, remember here that production function in relation to the cost function. We need this later on, okay, to analyze these firms' profit maximization and how they can survive in the market. Okay, depends on condition of the market. Is it perfectly competitive market, or all they're selling the same kind of product like lettuce, like corn or so on, or is it monopoly, or is it monopolistic competitive product firms and so on. We need the foundation is right here. The total cost function firm curve is to the right, and total production function is to the left. Okay.